Good morning. Welcome to Market Monday for September 16th, 2024. Last week, we remembered the 9/11 terrorist attack victims 23 years later. It's hard to believe it was so long ago. Last week, we also got August CPI inflation data, which came in at 2.5% compared to last year, which is about as expected. Zooming out, since 1990, we see overall inflation in blue and what's called core inflation, stripping out food and energy, in orange. They do this because you can clearly see these two categories are quite volatile, causing full inflation to bounce up and down much more than core. One thing that jumps out is the 2% inflation line right here. Decades of relatively stable prices. Then, after this peak here at 9.1% in June of 22, more or less back down to the trend. Here's a quick look at what's driving these August inflation numbers compared to peak inflation. Immediately, we see gas and fuel oil were causing the scorching inflation in 22 and are contributing to the cooling effect now. Interestingly, one item that hasn't cooled substantially is shelter inflation. So let's have a look. Again, zooming way out starting in 1985, here's the owner's equivalent rent in the 2 to 4% range for the 90s and 2000s. Even when home prices cratered during the global financial crisis, only then, in the depths of the carnage, did it get to zero. Then, with this most recent bout of inflation, peaking way up here at 8%, levels not seen in over 50 years, we're still stubbornly stuck at almost 5.5%. This is a gentle reminder that this alone accounts for about a quarter of CPI inflation. And if we still need to be clear about the flaws of how CPI is calculated, according to the federal government and CPI, the cost of health insurance has declined 30% over the past 2 years. It's down 8% over the last 5 years. Does that sound right to you? And today, we'll leave you with, despite its quirks, now that CPI is normalized and a real-time measure of inflation called trueflation is showing just 1.1%. And now that the Rolex watch index is down 30% from its peak in March 22, now the Fed can finally cut rates. But should they do one cut or two cuts? Don't we want two cuts or 0.5% to ease pressure on the economy and juice the stock market, making our account balances go higher? Well, careful what you wish for. Here's a look at the last 5 cutting cycles over the past 30 years. Take a look at the 1-year, 2-year, 3, 4, and 5-year S&P 500 stock market returns. Notice anything? The 2 cutting cycles starting with the 2 cuts had a stock market that was still down 4 years later. Time horizon, investing horizon. Does yours allow for potentially a 4-year drawdown before seeing new highs again? The other 3 cutting cycles, starting with just 1 rate cut, of course, had much better market returns going forward. What are you hoping for this Wednesday? Have a great week.